I'm gonna give you some of the basic financial tips that actually made me a millionaire. No, that's not clickbait. This stuff actually works. Let's check it out. Despite popular belief, you don't need to have some sensational windfall of money to become a millionaire. It's actually not that difficult in America today. We all aspire to be that, but we don't actually know what that means until you get there. Really, it doesn't mean you got $1 million in the bank. It means you're worth $1 million. That means your assets minus your liabilities mean $1 million plus. That's not a huge, lofty goal, even though it feels that way when you first get started. But let me tell you about the way that we've structured my finances, my wife and I, over time, so that we can continue to level up through every type of economy, recessionary, prosperous, it doesn't matter, we make money. So number one, we maximize the opportunities that we get when it comes to retirement. So I have a 401k, I still have W-2 income. Those of you who watch the channel, you know I always recommend side hustles. And if your employer gives you a 401k, you'd be foolish not to take it up to the match. Any more than that, maybe you're in an older place in life and maybe you want to get more money in your retirement account. That's all I recommend is the match. I only do the match. An extra little bonus here is if your company offers bonuses on an annual basis or a quarterly basis, make sure you can't cap out on your 401k, because what a lot of people will do is they'll get their bonus money going in as a portion of the same commitment. So 5%, for example, might go to their 401k, but they'll cap out at the end of the year. What I typically do is we get our bonuses once a year, and the month before bonus time, I'll literally stop my contribution to my 401k so I get the full bonus, because I don't want any more money going in my 401k than the employer is going to match, and then I'll cap out. So take advantage of 401ks. If you work for yourself, an IRA, a Roth IRA, it may be something you want to do. It may not. I'm generally not a fan because it's not free money where you have an employer match. You're just putting money in a retirement vehicle. All of you out there know I'm a big real estate fan. I prefer that over IRAs, Roth IRAs, but we'll get there in a minute. Another thing a lot of parents out there have is they have a 529 plan, a college plan for their kids. That's all well and good, and I can appreciate the fact that you want to have a retirement vehicle for yourself and then a strategy for your kids that has tax benefits. A lot of tax people out there will tell you this is the way to go. I do not believe in that. I don't think the tax benefits warrant it. So what did I do? In my investment account, where I normally trade securities, stocks, bonds, all that on my own, I have another sub account, which is my son's account. Rather than having a 529 plan, I have that secondary investment account with the same investment assets that I make and a couple long-term ones, companies you know, Apple, Amazon, Microsoft, big names that I think are going to last a long time and their value is going to go up over time. That's for my son's account. If he goes to school, we'll use that account. If he doesn't go to school, he can still use that account. And frankly, if something happens to me, he'll have money set aside in something other than just a sole educational fund that he can utilize and make reference to. And frankly, if I'm lucky and he goes to college and he gets a scholarship, he won't have to use that money for anything besides housing, and there might be plenty of money left for him to do something like start a business, which is what we all really want for our kids anyway, right? Moving on. The way we structure income and managing our accounts. I think a lot of married couples do this differently, and that's all good. If you want to have separate accounts, fine. What my wife and I do is we have a $10,000 household operating account. At all times, every single month, I'll replenish that. No matter what my wife spends in that account, it gets replenished back up to $10,000. That's there for groceries, household expenses, whatever it is. But for those of you, again, who follow the channel, you know that our primary focus is we put everything we can on our American Express card. And this is not some points endeavor. I believe that's the best way to utilize credit. Use credit, we pay it off every single month. All those bills, the Amex and everything else that I can, every single mortgage payment comes out of one account. It's the same account that all my income comes into, and effectively will leave to pay the credit card accounts. This way, there's not a whole lot of debits on my personal account other than subscription services. Things like Disney Plus, things like Amazon, things like your Apple stuff. I'm not a huge fan of subscription services. If you're gonna do it, I always suggest you monitor and know what you're spending and where you're spending, because things can quickly get out of control, particularly if you're somebody who uses the Apple App Store. You can forget about those subscriptions. Go into your account, check and see what you have there. You'll be surprised, you're probably wasting money and don't even know it. So what we've tended to do is we have the account that our money comes into, we have that household operating account, and those two accounts are split for a very good reason. I want to monitor the inflow and outflow of this account, and this account is really for living expenses. That's just life, you got to get used to it. What we'll do though is as money comes into this account, once it caps out at about $10,000, I'll take any excess money and set it aside in either savings or put it into investments like stocks and securities. Now, if I'm planning to buy a piece of real estate, which I typically do a minimum of 2 times a year, I'll put that in the real estate fund. At about $50,000, I start looking for single family residential properties. And if I'm looking for something like a little bit bigger, like a multifamily, at this point in my economic lifestyle, what I'll look to do is possibly sell one of those properties and 1031 it into a bigger property, or I'll save for longer. Right now, I've been choosing to save for longer because selling in this economy doesn't necessarily make sense. Although values are high, it's really hard to match the cash flow that I've gotten from some of these smart early on investments over time. And I generally do not believe in selling properties, but I know a lot of people do that to move up and scale up or level up in their businesses. That's also fine too. For the investment accounts, I have a Fidelity account with my son's account and my retirement account. I keep all of my trading in the Fidelity account. I have an active investment account, which I typically use. For a long time, I'd always been a fan of low-cost index funds, Vanguard's Index 500 fund, I believe it's VOO. But I've also started to get into more aggressive management of long-term investments. Things like your FANG stocks, your Facebook, your Apple, your Amazon, your Netflix, all those stocks that you know and love and you think are going to last a lifetime, plus some speculative ones that I thought were going to be real big winners. I invested in Peloton very early on, and I'm still in Peloton despite their financial struggles. I think they're going to have some longevity there. But that's my active trading account where I'm making decisions. Some people have wealth advisors who manage their accounts for them. That's all good. Good for them. I don't think that I'm really at that point for a number of reasons. One, I'm in the business, I want to watch the accounts. And two, because I really like real estate, as I mentioned earlier. I think all of us should be aiming to own real estate because it really can be a hands-off investment as long as you have a property manager that you trust. I happen to have a couple great ones, so it works out exceptional for me, where all I do is have to collect checks. And that's my third type of bank account. All of my property management income comes from my property managers. So you need to know that my property managers are going to do all the collection of rents and then the ultimate distribution to me after their fees. But I still have to pay the mortgage, taxes, and insurance, so the PITI, on my own. All of those properties have their mortgages taken out of one account, and all the income from the properties go into that same account. I'll know because the property management company gives me reports of who paid and who may not have paid if that's a set of circumstances or if I have a vacancy, but that account in aggregate is used to pay all the mortgages. At the end of the month, I siphon off everything except for about $2,500, which I use to leave in there for reserves. Those of you who are in the property management business might be saying, hey, you need reserves. My property management accounts, every single one of my properties has an individual account at each property manager, and each one of those has a reserve for that particular property type. My fourth type of account is my savings account. Now, I don't believe in the traditional long-term savings account. I use that account for two things. One, to hold the funds that we talked about earlier, and two, to hold no less than a minimum of 6 months of my family's living expenses. Because we spend a lot, that number has grown over time, and there's hundreds of thousands of dollars in that account because it's about 6 months of what it takes for our quote expenses, and then any money that I may be saving to put into a piece of real estate. So now you kind of know what our banking accounts look like and how we operate them. But the question that most people have is, okay, how do you know when to start looking for properties? Well, I'm always looking for properties. And I always know about how much excess cash we have in that reserve account to buy other properties. You should always be looking, and people will say, well, Chris, what about the markets? What about this? What about that? I don't buy for upside appreciation or devaluation. I don't care about the value of the properties. I never aimed to become a millionaire. I aimed to be having enough cash flow coming in to where I didn't have to worry about how much money was coming in or if I had a job. That should be your focus too. We focus way too much on net worth and not enough on cash flow. Focus on the cash flow and you'll be a millionaire literally before you know it, because cash flowing assets are typically the assets that have value over time. So I buy pieces of real estate because they cash flow, and I typically buy for each dollar, each door that I'm buying, each property that has a door, and if it's a 1-unit property, that's 1 door. If it's a 4-unit property, it's 4. If it's a 16-unit, that's 16. I try to get no less than a minimum of $400 to $500 a door in cash flow after paying all expenses in my PI, my TI, my property insurance, taxes, and insurance. That's a pretty lofty goal by all outward measures. And there's a lot of way people calculate this. They look at cap rate, they look at net operating income. That's all fancy stuff, and I'm in the business, and I definitely use that whenever we underwrite loans. But when it comes to my personal assets, I'm simple. I just want to know that I'm making about $400 or more a door. That's it. If I can't get there, I don't buy it. I don't care what the worth is. I don't care if it's overvalued or undervalued. I don't care about any of that. I need to know that it cash flows, or that I can get that cash flow on an upside appreciation or upside play. If I can put some value into the property and make it worth more. But I very, very rarely do that anymore. And the reason, one, I don't have a whole lot of time to buy a property, rehab a property, flip a property, do all that stuff. And mad respect to people out there who have that. I got companies to run, things to do. So I'm buying properties that are turnkey, that we can turn around and rent relatively quickly. Sure, we'll touch them up. Sure, we'll add carpet and flooring. Sure, we'll paint everything and we'll do all the things that are necessary, but I like newer properties. Almost all of my properties are post-2000 built, which also means I don't have to deal with legacy issues from the earlier properties, but that also means I can't buy a lot of the older stock properties in high density areas, so I tend to buy in the Midwest. I hope this has been an insightful look at the things that we did that ultimately made me a millionaire without even recognizing it. I think it was years into being a millionaire that I actually figured it out. But if you do these things and you do them over time, you'd be surprised how quickly these simple changes in mindset and ways of managing your money can actually shift your financial position in a matter of just a couple of years, not decades. We'll see you next week.